All right, guys, welcome to another week of the Educated Homebuyer Live, where Josh and I answer your real estate questions right here, provide some guidance, update you on the economy, and ultimately help you become the educated homebuyer. So, Josh, today we got some positive news when it comes to the economy. Finally, I guess positive is
It's
relative,
negative
right?
news. It's positive news
So,
for interest
job
rates.
openings were actually less than expected. We also saw yesterday ISM data was a little less than expected. So we've had some positive things. ADP numbers came in a little bit less than anticipated. So some things that show the economy looks to be slowing a little bit, and we're going to see some from some of the slides that we're going to throw up there that you thrown in there, Josh. That about hires and quits and kind of a little bit more of what's happening on the job side of the market that I think tells a bigger or a better story, rather, when it comes to what's actually taking place. So, with all that said, Josh, welcome. Another Wednesday. They just fly by.
The question is, did you get your technology working? Are you going to be able to manage the button push?
Josh, that is the question that everyone wants to know, including myself, and we will find out as we start to dive into to the data. Are we ready for that yet? Is that where we are in the show?
As ready as we're going to be, because no one wants to talk about the Super Tuesday results, because that was depressing.
Absolutely. So, with that said, let's take a minute here and plug the latest episode of the Educated Home Buyer, which is kind of in relation to what you just mentioned about Super Tuesday. We talk a little bit about politics in the housing market and what you're likely to expect, regardless of who gets elected. Kind of have some not predictions in there, but really kind of historically back what takes place in an election year when it comes to housing and really how much power these people have over the housing market. So if you haven't listened to that yet, go and check it out. And if this is your first time here, we appreciate you being here. We're going to go over some slides. In the description of this video, you'll actually be able to see those slides by clicking the link. So check that out, but let's do that, Josh. We are going to pull it up. There we go. We always like to start by taking a look at inventory. Inventory basically tells the tale. And at the moment, sitting at 498,000 single-family homes nationwide, a little bit more than we saw last week. But the key here is that it's 19% more than what we saw in 2022. So kind of a big shift there from the 2022 levels, but still well below, as you can see from this chart here, back to what we were looking at in 2019, 2018, as you can see on that chart there.
I think that's the thing that's interesting to me about this is how much everyone was talking this week about up 19% from 2022. And the first 3 or 4 times
I'm sorry. Let me back up, Josh. I said that wrong. Yeah. It's not up 19% from last year this time. It's up 107% from the 2022 levels.
Okay, so they're the line there over to the right. Okay.
Yeah. So my bad there. And let's take a look here at Orange County, where we're located. 1,971 homes, a little bit more than we saw last week. Huntington Beach is actually down 146, and we can talk a little bit about Huntington too, because put a listing on the market today, already getting activity, already getting cash offers, and just tells the sign. I mean, the title of this video talks about how the housing market is back on fire. And it really is, in at least in our market. And I know a lot of markets are very similar to ours. So it's going to be interesting unless we get a lot more supply. You've got people fighting over doing things that are somewhat unexpected in the environment that we're in. So let's take a look here at what happened week over week. So, Josh, I wish I could tell you what that says, but it is so small that I cannot. But we did see a gradual increase in inventory week over week. Nothing major there, as we discussed. And we've looked at the numbers previously. Last year, the same week, we actually saw inventory decline. So this year's positive because we're seeing more homes come to the market. Even though it's a small amount, we're not seeing those big declines, which, again, is a step in the right direction. But new listings. There's actually 2 new listings charts here. This one basically just shows about 52,000 new listings coming to the market. And we're back over here on the left-hand side when you're looking at this chart and it's comparing it 2023 or 2023, 2022 as well. But I like to look at this chart. This chart just kind of gives a better picture of what it looks like here. But 52,000 new listings. That's 5.7% more than a year ago. And we've had 18 weeks of seller growth. But what does it say? But that pace seems to be waning a little bit at the moment. So it'll be interesting. Typically speaking, May is the biggest month of the year for new listings to come to the market, at least here locally. So I expect that to kind of be pretty similar nationwide. April is the second biggest month of new listings, and March is typically the third biggest month. So, the next 3 months are going to really tell on what's going to happen to inventory, unless we see a big drop in rates, and that could alter what is typically a seasonal thing if we see that change. This just shows new listings to immediate sales, 14,000 immediate sales this week. That's 18% fewer than the same week last year. And immediate sales just shows buyers' urgency in the market, and basically just shows that at the moment we don't have a lot. And then let's take a look here at properties that are getting price reduction. So up a little bit from, I think, like 0.1% tick up from last week, sitting at 30.5% of new listings have taken some sort of price cut. Again, you can kind of see that little gray shaded area in the middle there. What is normal is somewhere between 30 and 33%. So we're still at the bottom of that, what that normal level is. Anything below that would actually be less price cuts than would be expected for this time of year. That's really the majority, I think, Josh, that I have there. What are we looking at here?
So this was interesting. In the episode this week, we had talked about, in trying to forecast the election, one of the big predictors is how is the economy doing heading into the election? If it's up, good for an incumbent. Recession, bad for an incumbent. But they also dug in. Nate Silver over for the New York Times, he wrote an article looking at consumer sentiment, both the Michigan Consumer Sentiment Survey, and there's another one. He said it's kind of surprising that the economy appears to be doing well, but when people dig into when they do the surveys and they ask people how they're doing, they think that the economy is doing poorly. So we look here, the green line here shows American satisfaction with their personal lives, and then the blue one is the direction of the United States. So people are up, 85%, had been up at the 90% range in their personal lives, but they see for the country, we had dropped all the way down to 11% and currently at about 17%. So fairly interesting in that most of you watching, most of us apparently think that things are going well in our personal lives, but the country is going awfully. Interesting. It's just an interesting thought there. We talk a lot here about inflation because we know how that trickles down into your household, to interest rates, moves real estate. This is a chart of price changes from 2013 to 2023. So kind of relating back to the previous chart of how people feel pretty good about themselves and their personal lives. Average hourly wages, the only thing that has outpaced the growth of average hourly wages in the last 10 years is hospital services. Unless you've had to go to the hospital, you're older, you're in poor health, have a health issue, you don't really see that. So housing is up 41%, wages were up 43%. And by all means, this is not to say, because we're going to get people in the comments, you idiots don't understand inflation's terrible, I can't pay the bills. It's just to keep some things in context. When we're feeling things, whatever it is that we're paying, we have to buy a new car, we've got to, put the kids in school, whatever it is you're paying, you're feeling that at the moment. And it's easy to lose context of the bigger picture that for people who are in the market to buy homes, who are college educated professionals, blue collar professionals that are well trained, wages have done well over the last 10 years. This here is another thing to keep in mind. I don't know if we've shown this chart here before, Jeb, but I've seen it now a couple times. I hadn't seen it in a while. This is the cost of food. The orange line is the cost of food going back to 1960.
Did you click on the chart? Did you change it?
Oh, I did not.
There we go.
You know what I did? Hey, Jeb, you know what I did? I did it on my slide here on my desk. That's not going to help anyone very much now, is it?
No. There we go.
So neither one of them got adjusted. So the last slide we were talking about, this is showing wages and then other forms of inflation over the last 10 years. But this here is share of disposable personal income spent on food in the United States. So since 1960, went from 17% of disposable income went to food, and now it's definitely trending up. but we were down to about 10%. It stayed there for the better part of, what are we looking at, 20 years pre-pandemic. So it's good to realize that, yes, food costs are up, and we don't like that. You never like the cost of anything going up, but historically, we're still on the low end of that perspective. Wanted to throw this chart in here. It shows basically inflation adjusted home prices. So people throw out, hey, prices are 70% above the 2008 peak. Oh my God, we're going to have a crash. Well, we are above the peak in real terms, but it's much less of a gap there. And again, that's not to point out to say, hey, there's no structural issues here or anything that's a problem, or you should be happy about the price of homes out there in the market. It's just, again, to give some context there.
Josh,
Jeff.
I saw something the other day. I think it was from Calculated Risk, and it basically showed that the number that we're up in nominal terms is above the peak was like 70% or something crazy like that.
Yep,
but when you took it in real terms, I think it was like 10%. For inflation adjusted. But what I like about that article is that he took it and he said, if you just took a $300,000 home, for example, and you just took inflation alone over that same period of time, that $300,000 home would be worth like $440,000 or whatever the number. I don't have them right in front of me, but it just shows you how much inflation alone impacts the price of homes without all the other factors that we're talking about here. Then once you throw super low interest rates on it and all of that, that's how things go bananas, which is essentially what we saw. But anyway.
Yep. You talked about earlier, Jeb, we got the ADP jobs report today. It always comes out on the Wednesday of the week, on Friday, we get non-farm payrolls. That's going to be the big number for us as NFP on Friday. Last month, we had an insane non-farms payroll number based off of all of the underlying data. ADP missed by a little bit. It wasn't expected to be huge, and it wasn't huge, but it was a slight miss. Not a huge correlation between this and NFP, even though they're tracking the same thing. So I don't know that tells us a whole lot about what we can expect on Friday. Wanted to throw this one in here just because it shows here JOLTS. You talked about JOLTS, job openings. If we have too many job openings, so too little a supply of labor for too many jobs, then you have employers having to compete on wages. Wages go up too quickly, which sounds good, but then that leads to inflation. I threw the red line on this. We are really close to back to the long-term trend line of where job openings should be. This will be interesting to watch the rest of the year to see if that number dips below that long-term trend and what that means. Because so much of the data that we're seeing here, including this chart, is telling us that the jobs market is not as strong as the government numbers every month, and NFP is saying that it is. So this shows, going back to 2022, the hire rate, gross hiring as a percentage of employment, that's a straight line down. And yet we're going to see here that over the last few months, NFP keeps coming out and we see this trend line up. So you had talked about ISM numbers came out earlier this week, the employment components of ISM. And again, that's manufacturing, but inside that manufacturing index, the employment is down. Like almost all of the numbers that we're seeing are down, and yet magically we're seeing NFP strong month over month. And that is one of the big elements that the Fed is holding on to, saying, oh, we don't need to cut. We're not ready to cut. So it is what it is. But in terms of looking at that, this was also here, Jeb, from Calculated Risk, just showing we had, some of you may have seen, Jeb, you sent it over to me. You saw it before I did, that last week, I forget which government agency is responsible for the CPI data, but they inadvertently sent out to members of the media information saying that they had tweaked the weighting of owner's equivalent rents in CPI. We had a hot CPI report earlier this month.
And it wasn't meant to be released, guys. It was an email that was supposed to stay within a certain group of people.
Yeah. And so we don't want to be conspiracy theorists here, but what reason would you have for changing the weightings, the methodology in the middle of a very important time to be getting accurate data? So was the Fed told that this was changed? Was anyone told? Was it done on purpose to give the Fed cover? Because what are we looking at? The Fed doesn't need to cut if inflation stays elevated, if jobs are doing well. So if the books are being cooked, we have underlying elements that are saying that it doesn't match up. I know I talk to a lot of people. You talk to a lot of people, Jeb. It just doesn't jive with kind of what we're seeing on the ground. But this chart here relates back to that owner's equivalent rent data, in that you can see it's trending down. The only reason why you would change that weighting is because it is not trending down as quickly as rents. So all of this data, you can look at it. We've got the red line is owner's equivalent rent. We've got the CoreLogic rents. Zillow observed rent index is the yellow one. Apartment list is the one that's showing the weakest. Apartment list is showing rents down year over year, but all of them are trending down. Just none of them, owner's equivalent rent is not trending down as fast as the other. So it's interesting that we would tweak that when we've talked repeatedly on the show, Jeb, that the thing that is keeping inflation higher than it should be is the fact that owner's equivalent rent has such a big lag in it. So this again showing owner's equivalent rent increasing while rent inflation is slowing. So same information depending on whose numbers you look at. It's just an interesting take on it. It tells us we should see inflation coming down. Jeb, I did the same thing as you did here, and I tried to throw it up on the prompter, and it is really hard to read these slides up on the prompter, although it is easy to look at the camera. Through the last one in here, this just shows the impact. Homeowners are insulated from higher interest rates because of 30-year fixed mortgages. And if you look at this, the interest paid on mortgages has gone up, but not nearly to the extent that all non-mortgage debt. That black line there is showing non-mortgage debt and how much that has increased while the Fed has hiked. But it hasn't had, the Fed hikes have not had the impact that they expected or hoped, because homeowners at least are largely insulated by that. Anyone with longer term debt that hasn't reset. Jeb, you and I looked at this one earlier. This is just showing down payments around the country. I thought you guys might think this is interesting. Average down payment, $84,000 in California, $98,000 in Florida. I forget which state is the lowest, but it's $5,800 is the average down payment. In Mississippi. So if you have $5,800 and you want to buy a house, Jeb, maybe that would be the place to look. So the last two slides here. This is the 10-year Treasury. We saw a nice little recovery this week. It could all go up in smoke on Friday when we get those NFP numbers, or if we get a more reasonable NFP number that matches up with the rest of the data, we might see some continued improvement. Not expecting anything huge. Maybe another 8 would be our best case scenario there. And what does that mean for you guys? Boots on the ground, actual real interest rates. Mortgage News Daily is reporting back under 7 at 6.97%. Optimal Blue a little lower at 6.82. FHA rates 6.5 from both of them. And as we always like to point out, I had a listener that I spoke to down in Chula Vista this week, and he had asked, I watched Mortgage News Daily, and I keep seeing that number, and then on the live every Wednesday, you guys report a lower number, or you're telling me a lower number. Mortgage News Daily and Optimal Blue rely heavily on direct lenders. For whatever reason, direct lenders use oftentimes their government loans, FHA via USDA, to subsidize and improve the pricing on their conventional. So anytime you look at this stuff, take it with a grain of salt, and you need to talk to a lender. Make sure you talk to at least a broker in the mix there if you're thinking in terms of a government loan, because you should be able to get a better rate.
All right, good stuff, guys. So gonna do this. I actually threw a link in the description below there where you can actually connect with our team here to get a quote anywhere in the states that we're licensed, and use it as a second opinion, or more importantly, use it as an opportunity to see where you stand, see what your monthly payment is, and really provide some guidance, or get some guidance rather from experts like ourselves who know our stuff. How's that? I'll put it lightly. Josh, today we talked a little bit on the Educated Homebuyer podcast. If you haven't listened to that, go check it out. You can find us on Spotify. You can find us pretty much everywhere, Josh. We are everywhere. People, if you want to find us, you can find us on Spotify, Apple, wherever you listen to podcasts. But we talked today again about the political episode, but we recorded today, and we what we did, guys, that referral link that's scrolling the bottom there that you see, we actually I've had over 4,000 people fill out that referral form. One of the questions on there is, do you have any concerns in the process, like going through the process? People fill that out often. What we did is we took all of those responses, put it into ChatGPT, let ChatGPT summarize it into the most commonly or to the biggest concerns that home buyers have during the process. What we did is we took that and actually did an episode on it today where we go over your concerns. These are, if one person has them, guess what? A lot of people probably have that same concern. So that'll drop next Tuesday on all those platforms that we mentioned. So if you're somebody that's, has some questions, you're unsure about some things, that'll be a good episode to check out. Josh, was that me? All right. So let's do what we do best and answer questions. Josh, we are going to start here with a super chat that came in from Praxia for $10. So thank you for the super chat. This has been a while since I gave back to you guys. Just want to say thank you. Your unceasingly great market and industry insights over the past couple of years have literally been the best in the industry. Thank you very much. I actually need a dictionary, Josh, to find out what unceasingly means. But I'm just gonna put it in the context of the sentence, and I think I know where we're headed. But it's a word I've never used. I've used cease, I've used ing on different words, but unceasingly I have not. Anyway, thank you for the super chat. Josh, what's your opinion on paying off a mortgage early?
We actually had Big G piped in and answered in response to that. Said, I paid my mortgages off. Best thing I ever did.
Mm-hmm.
No one ever went broke paying off debt, right? So I would never say it's a bad thing. What I would say is if you have one of those wonderful pandemic era 2.5%, 3.25%, 3.5% interest rates, I would think strongly before paying that off. Jeb, you and I have talked about it. We both refinanced and took advantage of those interest rates. And our biggest regret is not taking more money out at those rates. So I would say that's an interesting question. You can only answer it for yourself. As you reach later in life, it makes more sense. I really like the idea of heading into retirement, whatever that is. If you retire at 65, 70, 75, the ages are getting older. I like the idea of not having mortgage debt once you retire. But in terms of getting there, if you have a 3, 4, 5% interest rate, you can generally get better returns investing your money elsewhere. So you're settling for a lower rate of return, but there's definitely certainty there and there's comfort in it. So yeah, wouldn't argue against it.
No, for sure. And honestly, like when I had the 3% interest rate, 2.99, I was thinking, why do I even need to rush to pay this off? Now that I'm sitting at 6.5%, I'm like, the goal's to pay this thing off quicker, by paying more per month and just really trying to get rid of the debt. So I think to each his own. If you have something else that you can do with the money to get a better return, I think that paying off that leaving the debt there is not a problem. But if you don't, and just want to keep the money in the bank or just want some security, then pay it off. Who cares? Do what is best for you. Josh, we got a comment here from Marcus. Basically says, great video on the California Dream for All. So those of you who don't know, Josh actually went into, there's some guideline changes in the Dream for All for here in California. If you're interested in that program, it's essentially a free down payment for people in California. There are some stipulations. Josh broke it down in a video that he did on his own channel. So go check it out if you haven't done so already. It's good information. I haven't covered it. I'm not going to cover it again on my channel. But it's a good thing to know if you're a home buyer and have the potential to use it. So go check it out.
Do we have the link to the calculator on do we still have that banner? Because what I will say is that the most valuable thing about that video is walking through the calculator, and it'll be more valuable for you if you're considering, because the big question I get, Jeb, all the time is this a good deal? Is this a good deal for me? That calculator, a friend of ours built it. It's a really cool calculator. And it will tell you, everyone, once they plug in their numbers and run through it and mess around with it for about 2 seconds, they go, yeah, this is a really good deal if I can get the money.
Well, there you go. It's actually on the screen. So that link, The Educated, those are listening on audio. It's theeducatedhomebuyer.com/California-Dream-4-all. So California Dream for All coming after that. So check it out. All right. Let's get back to some questions here. So Big G just made a comment, said, or I guess ask a question at the end, but said, Gret Cardone says that when interest rates fall, then investor will begin to flood the market. Thoughts? I don't necessarily disagree with that. The cheaper money is, the more people you have accessing it, and using that money to buy things like property. We've seen the returns that a lot of these investors are getting. It's a safe return. It's not as volatile as the stock market. Also hasn't done as well as the stock market, say in the last couple of months, but it's a safer investment. It's a safer play long term. So you're going to have investors as money becomes cheaper. Yeah, there's going to be more investors in the market. But it's always made to be a bigger deal than it actually is. Home buyers still make up a large percentage of the housing market. Move up buyers, again, another large percentage. Investors are typically, somewhere between, I think it's like 15 to 20% somewhere. And those aren't institutional investors. Those are just mom and pop investors. I mean, the institutional guys are a small minority of who's actually buying homes out there.
Jeff, I agree with you on that. I read this the exact same way that you did the first time, but then I looked at it again. I think he just left the Y off. I think he said then inventory will begin to flood the market. So
I think
inventory.
That could very well be the case. What are your thoughts on that?
You will have less of the lock-in effect. So I don't know about flood the market. We've seen pre-COVID, we threw the chart up last week. Homeowner tenure in a home was approaching 12 years. It dropped down about 2 years during COVID because a lot of people said, hey, I'm going to take the opportunity with these ultra low interest rates to finally do my final move. I think over time, we're going to see tenure continue to extend. So there are always life circumstances that require people to move. And that will happen more as rates go lower. People will tolerate a lot when the cost of change is expensive. As it gets cheaper, more people will take that opportunity. In terms of flooding the market, I just don't see it flooding the market because a lot of people, other things being equal, will say, hey, I'm cool posting up here. We've all seen the headlines, especially younger generations, but people nowadays, I do feel like that experience economy, that people want to have experiences more. And when you look at saying, hey, if I have a fixed cost of my housing at a low interest rate, why would I give that up? So I don't know. It would bring additional inventory. And I think it's also important to remember Grant Cardone, above all else, is a master marketer. So I just consider what he's saying in the scope of that is that he's trying to get your dollars to allocate to his investments more so than he is trying to educate you. Smart guy, very good marketer, but just consider the source and why he's coming out with that information.
There you go. Moneybags asked the question, do you think the recent housing gains will decline will come the winter months of 2024? For me, no. I don't think any gains are going to come away come the winter months. I think the winter months are probably going to offer lower rates than what we have right now, which to me picks up a little bit buyer demand. And if nothing else, just stabilizes the housing market more than prices declining. Now, if you're in a market that has, we saw last week, I believe we talked about it on here, Josh, Texas, parts of Florida. There are some markets where inventory is actually up, basically based on the 2019 levels. I mean, they're back up to where they were prior to the pandemic. Those markets, a little bit softer market. Here in Southern California, we're still well below those numbers. So where we are, not likely to see much of a change. In a market that has that surplus, you could see some changes in the market that impact prices, but I don't think that it would be enough to really change the dynamic of the market, if that's the best way to put it. But going back to what you said a moment ago, Josh, I meant to comment on it and then I kind of rolled into the next question. With the inventory play. So one of my mentors who've, followed for the better part of 10 years, he believes that 5.75 is kind of the number to unlock a lot of the inventory out there. And the reason he believes that is because in going back and looking at studies of what new construction did, of what builders did in order to get rid of their inventory, they essentially bought rates down to a 5.75 number, and that unlocked inventory. So his belief is that as rates decline somewhere around that 5.75, you're going to get people that are willing to sacrifice whatever they have for that 5.75. Now, does that mean a flood of inventory? I don't think so. But I like the premise. I think the concept of the way he's thinking, it's an interesting way to think, and probably accurate way to think to some degree, but it'll be interesting, right? I mean, we haven't seen 5.75 and we haven't seen it stay there for any sustainable period of time.
Well, Jeb, let's look at this. The question behind that question, when people are asking us that, do you think that's going to bring a flood of inventory? What they hear is a lot of inventory will bring prices down and I'll be able to buy at a better price point. So first of all, I'm getting lower interest rate, but then I have more choices and hopefully a lower price point to enter at. The thing that we've always talked about, one of the very first episodes of the podcast that we did, Jeb, was why home prices are sticky to the upside. The reason is that people that are in a home and don't have to sell. I mean, people that have to sell, they're getting divorced, they're getting a job on the other side of the country. They're going to sell regardless of what happens. But people that want to sell are very loath to sell at a lower price than the highest price that they saw. And if we did see a flood of inventory, a lot of those people who were thinking, hey, that will be my opportunity at 5.75, at 5.25. If they look and they go, well, I wasn't counting on prices being 5 or 7 or 10% lower, I'm not selling. It'll be interesting. It could go a number of ways, but history has told us that people will post up and wait for prices to recover if they have the alternative.
No, good stuff. Good stuff. This is a good question, guys. Coming up here. Billy Cruz says, I just fudged my bank account today accidentally. I have my down payment and my savings, and my checking was short $155 after paying a big card to make sure my credit stays 715 for the approval, basically for the type of loan he's doing. He says, and it overdraft. So he got an overdraft because of how it got paid. So he's asking, will that affect his underwriting approval, Josh?
It shouldn't. So timing is everything here. It sounds like he's not in escrow right now, but let's say that he was in escrow and we got the contract 10 days ago and we're going to close in 20 days. I don't need a new bank statement. Depending on if there was activity that needed to be explained or we needed to show the earnest money deposit clearing the account, we might need a printout and we might see it. It's not something that goes into the automated underwriting. An overdraft is not anything that is a hard stop that, hey, you don't qualify because you have an overdraft. I think your worst case in this scenario would be you would have to explain to the underwriter what happened, and you would just explain exactly the way you did to us. And an underwriter could look at it and go, yeah, he was overdrafted, but he wasn't broke. It's just the money wasn't in the correct account when the payment went out. So big picture, I don't think it's a big deal. And the timing issue, what I was saying is if you're not under contract and you don't get anything under contract for 90 days, that will wash through those bank accounts and you wouldn't see it anyways.
Good stuff. Josh has a question.
I do.
Says, yeah, you do. Says, I'm curious to know how much do people put down in your experience when houses are between 1.5 and 1.8 million? Is it all cash, 50% down, or an investor? So I have my thoughts on it. Josh, what are your thoughts when you hear that?
Well, remember on the mortgage side, I don't ever see a cash transaction. So Jeb sees them. If someone's going to pay cash for a $500,000 or a $2.5 million property, that is a buyer, but they don't even show up in our world. So I only see people that are financing, and I see both. I have a client right now that's wanting to buy somewhere 2.5, 2.6, 2.7, and they're doing a 20% down. I also see people buying that price range. They're moving up from another home where they have $1 million of equity, $1.5 million of equity, and they're putting a big down payment. So Jeb, we have a mutual client selling their home, going to walk away with $1 million. So it's going to be a 50% down payment. Mm-hmm. In general, the folks that I see making the lower down payment are younger, really high earners because they haven't had time to build up the equity and they have a comfort level with the bigger payment. Older, more established people, they've built up some equity in the property that they're departing and they don't want a monstrous payment.
Yeah, I when I sold my home, I put about half of the money that I had gained in equity in that property and put it down on the new house. The other 400,000 I stuck into the market equities with a financial planner and let them do their thing with it. So I didn't want my money tied up in the property. That was just me. I took a slightly higher payment because of it, but it's okay. At the same time, we were putting in an offer for a client last weekend. Purchase price was $2.3 million. During the process of us writing an offer, they received an all cash offer, somewhere close to the asking price. So that was $2.3 million, all cash. I saw a transaction recently 1.6 million cash offer. So there is a lot of cash out there, guys. A lot of cash still floating through the market. And it's surprising to me to see cash transactions when you start talking millions of dollars, because it's like, God, it's a lot of money to tie up into a property, but people have the cash. So, but it's not always the case. And quite frankly, as a listing agent, cash is not always the right answer, unless the seller needs something specific. So at the end of the day, it really comes down to price and less about the cash side of things, unless the cash is also the most aggressive. So as a buyer, I wouldn't worry about competing against cash unless you're trying to get funny with how you structure your offer. So hopefully that's helpful. Got a question asking, if you want to pay your mortgage bi-monthly, do you always have to let your servicer know so that it can get applied to the principal? So Josh, maybe kind of mention why people do the bi-monthly payment to begin with. So instead of, basically it equates to one additional payment a year is how the bi-monthly payment works, but the payment structure is a little bit different than paying it every month, but there's a reason behind it.
Again, at risk of dating myself, when I started doing loans back in the 90s, you didn't have online payment portals. You couldn't set up whatever custom payment plan you want. You had to call, you had to talk to a customer service rep. It was unpleasant. And so there were third-party companies that would say, hey, you make your payment to us, we'll split it up, we'll apply it this way. But the answer to this question is you can generally do it. The servicers, the people that you make your monthly mortgage payment to, they have these really cool portals. You can put an additional amount of principal with the payment when it goes every month. You can split it and pay on different timelines. So in essence, with this, what you're doing is you're paying one part of it early, because it all has to be paid within that 30-day window. In general, it doesn't make the magic is not in paying it every 2 weeks. The magic is in making the 13th payment an extra payment. So 26 payments every 2 weeks is 13 full payments. So from that perspective, I wouldn't mess around with it. I would go to my portal. I would say, how much extra do I have to put with the principal to make the equivalent, and just put that in there. And when you set that up, you do tell them, please apply this to principal. If you just put an extra number, they can apply it however they want, including to the following month's payment. But if you tell them to apply it towards principal on your recurring monthly payment with the extra amount, and it doesn't have to be that magical number. You may say, hey, I want to put an extra $100. I want to put an extra $400, whatever number you like. Those portals will allow you to enter that. But it's not, I don't know that anyone really calls their servicer. I'm sure they would do it over the phone, but it's just such an unpleasant experience calling these call centers. It's easier to just jump online and do it in the portal.
Yeah, and now their rates are a little bit higher, depending on what rate you have. I mean, you're knocking more off that timeline by paying that extra payment and actually paying down the principal a little bit faster. I mean, a couple years ago, I think if you made one extra payment a year with rates low, you save a couple years off your mortgage. It was like, really? I mean, who cares? When I got it, when I was doing loans in the mid 2000s, I think, you made one extra payment a year, turned a 30-year fixed into like a 23 or something like that, 24-year loan, something along those lines. And we're back towards those rates. So probably saving 6 years or so off your mortgage by making that one extra payment per year with rates at 7%. Just a guess. You have to use the calculator to figure it out, but there's definitely some benefit to doing it if you can do it. And the nice thing is you can do it sometimes and not do it some others if that's what you want to do, and and structure it how you want it structured. So Ray has a question, Josh, asking about paying off an FHA early to get another property under FHA. What are your thoughts on that?
So I'm assuming pay it off and keep it so you can get another FHA mortgage. You can't have two FHA mortgages. There are a couple of exceptions to that. If you're moving a far enough distance, you can't have two of them in the same market. So you couldn't buy across town using FHA, but there are a couple of exceptions there, family size changes, etc. So assuming that, it's really not all that different. It's the same decision. If you have extra money to pay off that mortgage, you also have extra money to put in the bank and put a bigger down payment on the extra home that you like to buy and not have the limitations of the FHA. There's not a right answer here. If that's what your comfort level is, to throw the money into home equity, I get it. I would much rather have the flexibility of having the money liquid and available, especially just in uncertain times right now. No one saw the last 4 years coming. No one had that on their scorecard of what they were expecting to come. And in times of uncertainty, cash is king. And once you put that money into your home, you need permission in the form of an underwriter's approval on a loan to get it back out. And you don't know what those terms are going to look like. So I'm very careful in terms of prepaying mortgages, but there definitely are situations where it can be justified.
Awesome. Good answer, Josh. Want to take a minute here and ask a favor. 185 people watching. Would be very grateful if you are listening and you haven't done so already. If you hit the thumbs up, if you find any value here at all, we do our best to get your questions answered in a timely manner so we can get through it as quickly as possible. And the thumbs up helps the algorithm, helps push it out to more people, and helps us accomplish our goal. So that would be grateful. And also, if you're not subscribed, consider subscribing to the channel. It's really all about real estate education, guiding you through that process. And there is a podcast for those of you who aren't familiar, the Educated Homebuyer Podcast. It's on Apple, Spotify, but it's also here on YouTube. Check it out if you haven't done so already. You will become a smarter person when buying a home. Separate plug here, Josh. I mentioned to you today, this is something I've thought about a million times, but there literally is nothing out there that teaches people how to buy a home, full process, right? Unless you buy a course and all of that crap. And I have a course and I'm not pushing that, but what I'm saying is the best thing you can do in buying a home is become educated so that you know the process to something. You don't need to be an expert, but it would be nice to be able to ask the right questions so that you get the answers that you actually need to make the right decisions. And so for all of you listening, you're doing the right thing. Just understand that. It's just, and if it takes you longer to buy a home because of things, that's okay. Just become more educated. The more educated you are, the better off you'll be. Anyway, Jordan asked a question. It says, he has a 6-bedroom house, or maybe even a she, not sure. Says they have a 6-bedroom house in Utah, finishing out the basement, 1 bedroom, 1 bathroom, family room, and theater room. How much equity do you think that will add? Unfortunately, Jordan, impossible to tell, right? The best thing you can do is try to find homes in your tract, in your area that have similar layouts, that have that floor plan, or that have done similar things to their home and what that square footage looks like, and then kind of figure it out from there. But call your agent, whoever sold you your home, have a conversation with them. The easy answer is, hey, look, I'm doing this stuff. What do you think it's going to add? They should be able to give you a better idea. Unfortunately, being here in California, even if you were in California, it would be very difficult to answer that without knowing the neighborhood and all of that stuff that you're in. Pablo is listing their house for sale this Friday, contingent to buy a new one. Are there any potential risk or drawbacks to a contingent sell and buy that I should be aware of? The risk is when you accept an offer on your home, confirm, make sure you have in writing that the sale of your property is contingent upon you closing on that upleg, on that replacement home. Because if you accept an offer and you haven't built that contingency in there, even if you mentioned it's verbally, whatever, it needs to be in writing that your sale is contingent upon you finding and closing on that replacement home. That is how you get screwed. You just need to make sure you have it in writing. Outside of that, not a lot of risk. Having that contingency in there protects you. And ultimately that's what you're trying to avoid is being homeless by selling your home and not having a place to go.
Jeb, I don't know if you can hear this ruckus outside, but we're on the 65th, I believe, day of 2024. And this is about the 66th day of rain in Southern California. This isn't what I live here for.
Is it raining hard outside?
Yes. It's absurd.
Yeah. Guys, we're not cool with that. That's why we pay the money to be here. And people are slacking. It's the state of California. They're just not running it right. They're allowing rain to penetrate. It's not cool. Red Apples Kim, a viewer that shows up.
The ghost of Red Apples Kim, who we haven't seen in months, or at least she's not asking us questions anymore.
We're bagging on her. So sorry, Kim. Take it up with Josh. Just says, once your pre-approval has expired, do you have to start it all over again, Josh?
No, I tell anyone your pre-approval is good as long as the underlying information is still valid. If you lose your job, if you go buy a Maserati, if you miss a payment, any of those things are changing the underlying data. If you're paying your bills on time, not incurring any new debt, still on the same job, making the same wages, we may need to update information. We've talked about this in the show before. Credit report is only good for 120 days. After 120 days, we're going to have to pull another one, meaning from the date that we pull it, your loan has to be closed. Bank statements within 60 days of the note date, pay stubs within 30 days of the application. But again, you know your situation. As long as your underlying situation hasn't changed, your pre-approval is still going to be valid. You just may need to update some information.
All right, good stuff. House Hacker is asking, are there any lenders offering 100% financing, Josh?
Do you see the flyers come through, Jeb? If you have in California,
No,
many other states,
I unsubscribe to everything.
You're smart enough to unsubscribe to them. They'll come through. So there are people out there saying they are offering them. What's more common, there are a lot of down payment assistance that don't require you to be a first-time buyer that basically piggyback on an FHA. You get a high interest rate FHA loan and they come up with the down payment for you. So are there options out there? Do they exist? Yes. Are they the greatest options? Probably not. If you can scrounge up even to 3 to 3.5% down payment on an FHA, you're going to be better off than most of those programs that exist.
All right. All right. Joyce is asking if we've ever seen HOA fees built into the monthly mortgage payment. I have never seen HOAs escrowed. Josh, is that a thing?
Not that I'm aware of, just because it changes. You know, one of my properties, the management company's changed 3 times in the last 5 years. The lender has a vested interest in making sure that your property is insured, that your property taxes are paid. You can be foreclosed on for overdue HOA dues, but far less frequent and generally a much smaller amount. So they just don't generally care to go that far to make sure that those are getting paid. I'm sure it has happened. I'm sure there is a bank or someone out there that would be interested and willing to do it. I've never seen it.
All right. Calvin asked a question. Part of it's one we get all the time, but the second part is how much do mortgage rates vary state to state? Do they vary state to state? I guess, Josh, is the better question. And how much below the mortgage dues daily numbers that we showed earlier could you actually get an interest rate if you had really good credit?
So it's a little known fact that back in the day, back in the 90s when we started doing loans, you had rate sheets and you had to look at that rate sheet and all of the different adjustments that you had to apply. There were state adjusters in there. And I'm sure that many lenders still have the state adjusters. There's not a rule. Fannie Mae doesn't say that loans are more expensive in Indiana than they are in Texas. But lenders, for whatever reason, do have some variations. And generally, I think it was based off of default rates being greater in some bigger metropolitan areas, but generally varied by state. Because we price everything in pricing engines now, you put in the terms and it just comes back. We put in the zip code of where the property is and it's already accounted for. I would assume they're still there, but they've always been very minimal. And I'll bet they were less than what they were way back in the 90s. And the second question there, if you have perfect credit, how much better can you get it than Mortgage News Daily? We tell you guys here every week, a well-qualified borrower should be able to do a little bit better than either one of those indexes is showing. But the thing is, it doesn't take into account, and they're not showing you points, what that looks like, all of the fees. So those are a good idea of what it looks like. But if you're thinking you're going to get 3/8 or 0.5% below that, it's not going to happen even for the most well-qualified borrower without paying a bunch of points above and beyond what they're quoting.
All right. Samantha, can you ask a seller to buy down the interest rate? What are the chances of that happening? The first part of the question, absolutely. You can ask them to buy down the rate. Typically, what you would ask is for a certain amount towards closing costs, and you would use that amount to buy down the rate. So you're not saying, hey, will you buy down my rate? You're saying, hey, will you give me $5,000 towards closing costs? And you're using that $5,000 to buy down the rate. And you would find out what amount you wanted based off having a conversation with your loan professional. So if Josh is my mortgage professional, which if you want to talk to Josh and want him to be your mortgage professional, there's a link right there at the bottom that you can make that happen. But if you say, Josh, hey, I'd really like a 6% rate. Josh would say, well, you need 1.5 points to buy that down. I'm just using those numbers. You need to go back, and then that's how much you would ask for from the seller. Second part of your question is, what are the chances of that happening? I think in markets where homes are sitting, not moving, homes that are, they've been on the market an extended period of time, there's a motivated seller behind it, higher likelihood of that taking place. In a competitive market situation where there's multiple offers, ton of people going through the open house, sellers sending back a multiple counter, you probably don't want to be the only buyer asking for closing cost unless you're going well above the asking price and your offer is way better than everyone else's, because there's a good chance that the seller is not going to consider it. So it all depends on the situation and the property and inventory and all that stuff. Real estate is local, as we often say. Love for Puppies. Another question says, given that 1 point cost 1% of your loan amount, so let's explain that real quick. So what that means is if you're buying a $500,000 home, 1% is essentially $5,000, just for easy math there. Is 1 point worth more on an FHA loan, Josh, or conventional? If you're buying down the rate, for example.
It's a yield adjuster to the investor. The investor is agreeing while they own that loan to accept less monthly. So to do that, they want a payment up front in the form of those points. And in general, they go just as far on a conventional as an FHA, not any real difference there between the two of them. Jeb, we do have another situation over here, though. Kim was kind enough to spare my feelings and say she still watches, but sometimes she doesn't have any questions. But then she follows up with a question that says, is US Bank a good mortgage lender? Kim, I thought I was your mortgage lender. Now you're hurting my feelings. Now you're looking around and checking out other options. But Jeb can actually answer this without divulging too much of your personal business. Jeb, you actually, that's who handled your financing.
I did a loan through US Bank a little bit ago. In fact, when I bought my house and when I refinanced my house, and the reason I went with US Bank because I was getting a jumbo loan, and they were more aggressive on the jumbo side than most lenders out there. When it came to conventional, Josh was more aggressive. So depends on what type of loan you're doing. They can be really aggressive, or they can just be, par for the course, if you will. So that's the reason that I decided to use them. Any other circumstance, I would have used my preferred lender in that case, but to each his own.
And even at that, Jeb, they're in and out of the market. They're more in than out, but there's been times in the last couple of years when you're like, wow, that's not that great. And other times you're like, I don't want to compete against that in terms of the jumbo stuff. So in and out. But everything, what I will say is with any of the big lenders, more of a bureaucracy, a longer time frame. We have another friend that works for I wouldn't say an even bigger bank, but also a big bank and in the private client group, and they can do amazing jumbo rates. But he's telling you it's going to be 60 days to get that loan closed. So more goes into it than just the rate. But I would say they're a reputable lender, especially in the jumbo space.
Here's the deal, Josh. I now am thinking about In and Out and thinking that my wife.
You're ready to shut the show down and head out?
My wife is making salads for dinner, so I'm going home and having a salad. But I'm going to be thinking about In and Out the whole time. Just
hit the drive-thru on the way home and don't tell her. Don't get a drink.
Don't walk in with you don't just hit the drive-thru. You hit the drive-thru and then you sit there for about 30 minutes while you get your order taken. Christian doesn't really have a question, but he has a comment that I think is important to note. It says, in 2022, 17.5% of American households earned over $200,000 a year. Can we stop calling the market unaffordable? 17.5% of all households. Well, guess what it is today, Christian? It's 14%. 14%, at least here in California, 14% of Californians can afford to buy the median home price. The median home price. That is unaffordable for most people. Josh, during the teen years, I mean, we were like 30-something% across, weren't we? Of people could afford the median home price?
Oh, no. Like in 2010, 2011, 2012, we were up in the high 60s in California.
So when you go from 60% down to 15%, that's unaffordable for most people out there. I realize there are exceptions to the rule, but it's from a bird's eye view, the housing market is unaffordable. We realize that. Not a lot we can do to change it, but I'm fully aware that it is impacting a lot of people's budget and what they're actually able to do. We got a question here from Mona. I'm doing a bridge loan listing next week. So Josh, I'll have you touch on what a bridge loan is, and closing on a new house in April. Would it be better to take a lower offer to avoid a bridge loan or wait for a better offer? So Josh, what is a bridge loan?
So a bridge loan is a lender loaning you some of your equity And they generally also do the purchase loan for your new purchase. And most times they will ignore that you have this bridge loan and generally a first mortgage on your current property and just qualify you for the new home as if you were walking in as a regular buyer with those bridge loan funds in hand. That's the positive of it. It gives you flexibility. You don't have to be contingent. Jeb went through some of the downsides of contingent sales. The downside of going with the bridge loan is they're expensive, and you're generally limiting yourself to a lender that does that first mortgage purchase on the home you're buying, and instead of having all of the options out there in the world to get yourself the best terms. So it can be expensive. I would want to quantify it. So before we would ever be able to wade in and give you advice on this, we have to see, what does the financing look like on the purchase? What is the charge for the bridge loan? And how does that compare to what's available out in the market?
There you go. Good stuff. De Rio de Beccia. I have no idea. Do mother-in-law suites add value? And I would say yes, if done correctly, if done in a workman-like, manner. Done correctly is the right way. They can definitely add value to a property, but it all depends on what you're adding, how much square foot, how does that set up the property? By adding that suite, what is the flow? How much land do you have left? A lot of different things, but I think the easy answer is yes, it does. Josh, let's see, what else has we got?
Here's an interesting one,
Yep.
Jeb. Do lenders put buyers in different buckets and give them different rates depending on how they were referred? Actually not allowed under the law currently. So loan officers, their compensation has to be set up where it doesn't matter the source of the loan. The only thing that can change in terms of their compensation is if they're house accounts. Let's say that the company is generating leads, they can give that to the loan officer and pay them less on a self-generated lead source. That's the only way that can happen. What they wanted to get away from is the Wild West days of 2005, 2006, 2007. Educated shopping home buyer comes in and they get a really attractive interest rate, and the nice, friendly, trusting person comes in and they end up paying 5 points for their loan. We wanted to take that out, where if you're talking to someone, that everyone they're talking to, they have to price the loans the same and they're going to get compensated the same. Now, are there some rogue actors out there that aren't following the loan officer compensation guidelines? I'm sure there are, but the way that it's written right now, if they're compliant and if they're not compliant and they get audited, they're going to be in fairly big trouble. So no, we can't have different pricing for different groups. And that goes all the way back down, Jeb. We have HMDA data, which is home mortgage data, blah, blah, blah. But it's the government tracks all sorts of things, not just your age and location, but your ethnicity, your sex, all sorts of things. And you're allowed to check, I don't want to provide this. I would say if you're going through your loan application, provide the data, because the government does analyze it and they use it to make sure that there's no bias against any individual group out there. Now, the government can weaponize that data. I don't love it, but if you're interested in those things, I don't really see a downside to you providing that data when you complete your loan application.
All right. I saw a question here. David asked a question. It says, can I, as a real estate agent, represent myself in a home purchase and use that commission towards the down payment? Josh.
You want to know the funny part? Job Aid came across from a service that I subscribe to that was breaking this down. The short answer is yes. It does vary on the type of financing that you're doing. Some jumbo lenders will not allow you to do it, but Fannie, Freddie, FHA will. I will always go back when I'm answering this question and refer to that, because it just doesn't come up that often where we're representing a realtor and the realtor wants to use their commission. Represented a realtor who found us through the show last year on her personal purchase. And what she did is just took the compensation and got it as a lender credit and covered all of the closing costs. So sometimes if the costs exceed the commission being offered, that can be a way around it, no matter what you're doing, jumbo, anything that would be outside of those guidelines. But the easy answer is yes. Just go through the specifics with your lender and they can tell you exactly how to structure it to stay on the right side of the guidelines.
All right, Josh, got another question here. Just asking if you have money in escrow and your loan is supposed to close on a new build soon, and the rate you wanted to lock in is way off from what you were estimated it would be, if it's way off from what you estimated, what would be your options at that time?
We've talked a million times here on new builds, Jeb. That 150-page contract is very builder friendly and not super buyer friendly. And it will tell you basically what your options are, but I don't think you would have a lot of options. The lender probably gave you an option to lock or float. So you're floating. I would be willing to bet there is a disclosure in there that says if you float the interest rate and rates go up or you don't get the rate that you want, there's not really an out there. But the only way to know would be to dig into that monster contract that builders have you sign.
All right. Kim wants to know if you're in the office tomorrow, Josh. Josh, you're in the office every day. So
I'm in the office every day,
so
even when it's raining. Is it raining tomorrow? Maybe we'll take a snow
Got
day.
it. I hope not. Calvin says, if interest rates in the economy stayed the same, how long would it take before the home listings and inventories get back to historical averages? Well, here's what we know, Calvin. Last year, interest rates climbed, and inventory actually went the other direction. This year, rates are down a little bit from last year, and inventory slowly creeping to the market. Nothing crazy. So we're ways off, at least here in Southern California, where we are, from historical averages. So probably take quite some time. I mean, at the moment, buyer demand is still there. I mean, there's a chance that it doesn't. And I mean, over time, people will it will be the new norm and people will eventually sell, but we're not there at the moment. I don't have an answer for that. It's further out than you want to believe it is. How's that? And I don't want to believe that that's the case, because that would just be dismal for everybody on both sides of the equation.
And I would say, most importantly, the odds of both interest rates and the economy staying the same for the foreseeable future is negligible at best.
Exactly. Eric Rubin says, can you take a second mortgage out to cover the equity gap in an assumable mortgage? So let's explain this for a sec, Josh. So say, for example, Josh has a $500,000 home. His home is worth $500,000. Let's say he bought it for $300,000. He's gained $200,000 in equity. We'll just assume he didn't put a down payment. So he's got $200,000 in equity in that property, but Josh was able to refinance and take advantage of a 3% interest rate. And let's just say he has an assumable loan. It's an FHA, a VA, or maybe even an adjustable rate mortgage. It's assumable. So Eric wants to buy Josh's property and assume that mortgage. Well, guess what? There's $200,000 of equity there that Eric needs to pay Josh in order for Josh to let go of that mortgage, right? He's not just going to give it to him at $300,000 because he's got equity in that property. Is there a way for Eric to get equity to pay for that gap, Josh?
Yes.
Without having to come up with cash.
Yes, all of the assumable loans. So Fannie Freddie, you cannot assume. Fannie Freddie fixed rates, you cannot assume. So FHA, VA are the more common ones, and both of them will allow you to have secondary financing to cover that. You will have to meet the down payment requirements. So VA doesn't have one. FHA, you'll have to have your 3.5% equity in there. Now, what I did hear from a friend of mine who is also an expert in VA loans is that your secondary financing, if you're assuming a VA, also has to be assumable. I wanted to call the Phoenix Regional Loan Center or the VA and confirm that to be accurate, because most second mortgages out there are not likely to be assumable. And that was a rumor that I had heard. But short answer to that question, yes, you can get a second mortgage. You don't have to just come up with the money out of your own pocket.
All right. Good stuff. We're an hour and 3 minutes on the show. If you haven't done so already, do me a favor, hit the thumbs up if you found any value tonight. If you haven't subscribed, consider doing that. If you'd like to work with Josh, myself, our team, get your finance taken care of, really work with us as experts. Don't get caught up in the hoopla of all the morons out there in the industry and the people that don't really know. We're giving you the education. We'd love the opportunity to help you. There's a link scrolling the bottom. Go there and let us guide you through that process. Josh, we're gonna end the night on a slightly different note. What are your thoughts on Bitcoin?
Volatile. Jeb heard me. I pulled up my Coinbase account and I looked yesterday. In a matter of 4 hours, there was a 15% drop in the account value. And in that 4-hour window, about half of it had recovered. And then it was all back today. So you just have to be comfortable with volatility. Use it as a very, very small part of your portfolio. I think for people who are saving and investing, it plays a role, but it's like less than 5% of your investable assets. And it should absolutely not be your down payment and closing costs in Bitcoin. Although it might work out spectacularly, it also could work out spectacularly poorly for you.
Yeah, I'm just going a different take entirely. I'm not a Bitcoin guy. I'm not a crypto guy. I can't get into it. I am very logical. I'm a math guy. I mean, I come with a computer science major, guys. Math makes sense to me. Numbers never lie. Crypto, I have no idea what the hell it is. I know what I've been told it is, and I can read and I understand 60% of what is written out there. But when you just make up something and just say, hey, this is what it is, this is what I can't get behind that. And great. People are making a lot of money. All the best for anybody that's invested in. I understand why people would do it. I just can't get behind it. I don't understand it. I go with the Warren Buffett mentality on this sort of thing. Like, don't invest in things you can't understand or explain to someone else. I can't explain it to anyone else. So I'm out. I sound like a shark there. I'm out. And for that reason, Josh, I'm out.
You sound like a grumpy old man.
Hey, perhaps I am. My wife would say I am.
Yes.
That's okay. I'm okay with that, Josh.
I can't believe on a night where it's raining and all sports get canceled, you're feeding the kids salads instead of going to Joe's.
No. The kids aren't going to eat salad. Are you kidding me? My kids wouldn't touch salads.
Okay.
No, they're eating something that's not healthy for them. My wife and I are eating salads. But anyway, guys, we appreciate you being here. What are you going to say? You're going to say something?
Let's load up and go to Joe's. Tell the wife.
I tried that and she said Friday. So, hey, anyway, appreciate you guys being here. Appreciate the support. Next Wednesday, we're back with another episode. I'm thinking about appetizers. Episode of the Educated Homebuyer Live. We'll see you then. Adios.
Amigos.
See, you failed again, Josh.